We will now turn to income approach. Previously, we covered expenditure approach, which can be used to calculate GDP. So let's turn to income approach. With income approach, what we do is we track different types of income earned by domestic factors of productions, domestic inputs, okay, domestic workers, for example. So there are different types of income: wages earned by workers, profits earned by business owners, entrepreneurs, interest earned by landlord, interest earned by creditors, and rent earned by landlords. Theoretically, when we sum up all these income earned by domestic factors of production, it should be equal to the market value of output, which is GDP. So to understand the logic of income approach, let's take a look at an income flow chart. So this is similar to the one that we have seen before, okay, with some addition. Once again, we simplify things by assuming that there is no foreigner, there is no government. There are only two types of economic entities in this economy, which is domestic households and domestic firms. So firms are producers. Firms produce goods and services and sell them to household members. So previously, we have looked at the black arrows. Okay? So firms sell goods and services to household members, and household members in return pay for these goods and services, which is expenditure. So now let's focus on the blue arrows. When firms produce goods and services, when firms produce all these output, okay, goods and services, they are made of inputs. They're produced using inputs. So inputs are resources that are used to produce output. For example, workers or labor, land. By land, we do not literally mean just land. Obviously, by land, we include land, but it's more than that. Okay? By land, we usually include natural resources, such as timber, okay, coal, okay, oil, and so on and so forth. Raw materials, another type of inputs. Okay? So, for example, steel for cars, right? And then agricultural crops for food, and so on and so forth. And then we have capital. Capital, by capital in this course, we generally mean goods and services that can be used to produce other goods and services. We mainly focus on physical assets, for example, machines, factory plants, equipment, and so on and so forth. Okay. So who provide all these inputs? Okay. Well, the household members. Household members provide all these inputs to firms. Okay. So let's focus on the blue arrow. Household members provide all these inputs to firms. So in return, firms produce goods and services, okay? But obviously, all these inputs cost money. So after firms sell these goods and services, firms get some proceeds, and firms will pay household members the income. One thing that we tend to forget is business owners are also household members. Okay? Business owners do run firms, they produce goods. However, they are also household members. So they will also receive income or earn income. Okay? So when you look at this, okay, it is not too hard, I hope it is not too hard to see that the income earned by domestic factors of productions is the same as the output, as the value of goods and services received by firms. Okay? So once firms sell goods and services, they receive the proceeds, so they distribute the income to household members. Okay? So that's why theoretically, if we can track this amount of income earned by domestic factors of production, domestic inputs, then we can get the amount of GDP, the value of GDP. But that is just theory. In practice, there are few adjustments that we have to make before the income earned by domestic factors of production is equal to the market value of output, which is measured by GDP. So the first adjustment that we have to make is depreciation. Okay? So when you look at companies, when we consider a factory, for example, so if a factory sells $1 billion of goods and services, $1 billion worth of goods and services. Okay, so cost aside, other costs aside, do you think it will distribute the entire amount of proceeds to inputs, to workers, to business owners, to lenders, to to landlords, and so on and so forth? Do you think that's the case? The answer is no. Because in order for the factory to maintain its existing productive capacity, it will have to replenish the capital goods. It will have to put aside some amount of money to repair the machines, right? To upgrade the computers, okay? Or to buy new equipment, to buy new computers, to build new facilities in order to stay as competitive. So that means of this $1 billion, some amount of money has to put aside to maintain the existing productive capacity. And that amount of money, in accounting, a lot of you are familiar with the term depreciation. So that refers to the wearing out of capital goods. But here, depreciation can also be called capital consumption allowance. So those are the terms that we can use interchangeably. Okay? So if we take away depreciation, okay, GDP minus depreciation, okay, so that would give us what we call the net domestic product. Okay? Net domestic product is the amount of goods and services that can be consumed without affecting future productive capacity. So in other words, this amount of money, depreciation, is not going to be earned by any domestic inputs. It's going to be put aside for replenishment of capital goods. Okay? So GDP minus depreciation, we take away depreciation. Okay? Another way to get net domestic product, depending on the data that you are given, is that we can sum up consumption and investment and government spending and net export, so that would give us the GDP. And then we take away depreciation from the investment. Well, by the way, in this course, when we say investment, unless you are otherwise told, we mean growth investment. So that means it hasn't been adjusted for depreciation. So once we adjust for depreciation, that's called net investment. So consumption plus net investment plus government purchases plus net exports, that will give us the net domestic product. Okay, so that's the first adjustment. Okay. Another thing that we have to adjust for before GDP or output is equal to the income earned by domestic inputs is what we call the net foreign factor income. So when you consider an auto company in the Midwest, in Michigan, for example, Honda. So Honda factories that operates in Michigan. Okay. So suppose it has a profit of $1 billion. Okay. So is this entire $1 billion earned by Americans? Many of you probably are aware that it's not, okay? Because there are foreigners who work in that factory. Okay? So as a result, we need to make that adjustment. Okay? So that adjustment is net foreign factor income, which is the income earned abroad by domestic factors minus income earned in the domestic economy by foreign factors. In other words, it is the income earned abroad by Americans minus income earned by foreigners in the United States. So if this is a positive number, what does that mean? Okay, so if we have a positive number for net foreign factor income, what does that mean? Well, what that means is the income earned by Americans who work abroad is greater than the income earned by foreigners in the United States. There is a net inflow of income into the United States. In contrast, if we have a negative number for net foreign factor income, what that means is the income earned by Americans who work abroad is less than the income earned by foreigners who work here in the United States. So in other words, there's a net outflow of income into net outflow of income out of the United States. Okay? So we need to make that adjustment. Okay? So we adjust for net foreign factor income. So one thing that we notice, which is not what we are focused on, but it is good to know, is that once the GDP is adjusted for net foreign factor income, then we will get GNP, gross national product, which is the goods and services produced by Americans. Okay? So now, I keep saying income earned by domestic factors of production, domestic inputs. In fact, there's a shorter name for it. It's actually the national income. Okay? So now we are going to turn to a few other economic indicators. So we'll talk about GDP, a very important economic indicator. Now we can turn to other economic indicators. Income. Okay? Income obviously is an important economic indicators. There are several measures of income. Okay? National income, which is what we have been talking about, the income earned by domestic inputs. Personal income, income received by household members before payments of personal income taxes. And then lastly, disposable income, which is the income that we have left over after we've paid all taxes, including personal income taxes. So what's the distinction between these these three? Okay? Let's look at the first two. Income earned by domestic factors of production. And then the next one, personal income, is income received by household members. They look very similar, but when you look at it closely, they are different. What is earned is not necessarily received. What is received is not necessarily earned. So shortly, we will look at how we can calculate personal income. But before that, let's just take a very quick look at what we have done so far. National income is simply equal to GDP adjusted for depreciation and adjusted for net foreign factor income. So now let's